Okay, so we had finished working through the October 15 paper, and now we're working through the May 15 paper, for which I still have no solutions. The only student last semester I'm remembering now was Tebs. Tebs, yeah, couldn't be bothered to come to do past paper, so I didn't do them. So we started this pizza question last time. The pizza question is a company that has a sub, and then is it another sub? And another sub, and then a joint op. Is that right? Like that. Parent, sub, joint op. The joint op comes out the parent, hey? And so last week we had done the first required, which was because we were running out of time, right? So that's why we were doing it in pieces, but that's not the way we would do it in the exam, in pieces. So last week we had just a little bit of time, so we worked on this goodwill number. And what we found is that there was, in the first sub, there was goodwill, and it was impaired, so we had a lower goodwill number in the statement of financial position, which is what they asked us for. In the other sub, there was a bargain, and then in the joint, it was a joint venture, wasn't it? There was goodwill, but goodwill in a joint venture is included in the investment in joint venture. So in the line goodwill on the statement of financial position, it was just this impaired goodwill, and that's what we had worked out. So now, in part, the rest of the question that we need to talk about, they ask that we need to do today, they ask us to do a consolidated statement of P&L and OCI for the year. I don't know if we had started that. No. So when we look at a consolidated statement of profit or loss for the year, it's parent plus sub plus sub. I don't know if there was one that was bought a bit through the year. I think was it the joint venture or the other sub? I'm not sure. The other sub. So just be careful, because this sub will only be a subsidiary for X months. Yeah. So it's parent plus sub plus this sub for X months. Joint venture is one line. Yeah. In a share of profit of joint venture. They also then ask you to do a statement of changes in equity, and we know the big numbers there: retained earnings, NCI. So you can set those up. Remember that when we have the subsidiary, we have the three NCIs, isn't it? We have an NCI that sits there, we have an NCI that sits there, and then he gets an extra piece. Yeah, so an NCI there, an NCI here, and an extra piece. And that's for that one line in the statement of P&L, which is profit attributable to NCI, which then flows into your statement of changes in equity. However, yeah. I mean, you can get a lot of marks from just the basics, right? Setting up your P&L, adding. Part D, we can get to once we've done B and C. Part D for 3 marks, 3 whole marks, asks you what the accounting treatment would be for a joint operation. Yeah, and we know that that's a proportional consolidation, although I don't think that's the exact wording that you must use, but that's essentially what you're doing, is you're consolidating your share. That's what you say. We consolidate our share of assets, liabilities, income and expense, plus we consolidate our own assets, liabilities, or plus we include our own assets, liabilities, income and expense. Okay. I don't know if I should time us. I don't think I'm going to worry. You know, third year modules now, time is not a factor anymore, I would say. Do you feel that too? Yeah. I think I used to always times before when it was 2 hours, because you're surprised sometimes, like your time's up and how far you still have to go. But with third year, I haven't, well, now with the extra time, I haven't found that that's an issue. Let's have a look. I'm going to first do this side over here. Okay, so I'm first going to do P&L. We started with profit for the year. So they gave us 950 and 710 for the parent and the sub. And then they gave us, for the subsidiary, they gave us 350 for the year there for the subsidiary. We only put that in for 7 months. Okay. Then we look at our adjustments. The only adjustment that was given in the actual information was to do with a machine. It was a machine that was sold buy spaghetti to risotto. The profit on the machine was 15,000. Do you agree? But remember, I'm working with after tax. So I adjust after tax. I make profit smaller. And then there was the depreciation adjustment, which is 2.5. Do you agree with that number? Also after tax, and that makes it bigger. Okay. Then we had a number of other things that needed to be adjusted. The first was dividends. Okay, there were dividends paid all the way in the group. There was a dividend paid by gelato to the parent. There was a dividend paid by risotto to spaghetti, and there was a dividend paid by spaghetti to the parent. We need to eliminate all three of those intercompany dividends. So I eliminate the 35 dividend, my share, the 95%. I eliminate the 22, spaghetti's share, and I eliminate 40, my share. Okay, then in the current year we acquired risotto. There was a bargain purchase. It makes my profit bigger, that bargain purchase. 11,875 was the bargain purchase we had worked out. And now I can't remember what that 1.5 adjustment. Yes, the impairment. And then somewhere in the story they told us about that impairment. Jeez, it's the third time I've forgotten that impairment. The impairment of the goodwill, it comes off at 1.5. You happy with that number? Okay, so quite a few adjustments on that number. Then, share of profit in associate was straightforward. I kept looking for things to adjust, but there was nothing. Do you agree? 24, 40%, Bob's your uncle. Oh, and it's not an associate, is it? We can't say associate if it's not associate. I don't know, I even wrote it. JV. Okay. Then, other comprehensive income. Other comprehensive income, they told you, was 6,101 for pasta and 4,718 for spaghetti. It was in the trial balance. But we know that we must reverse anything to do with group companies. So the mark-to-market reserves on spaghetti, risotto, and gelato would all be reversed. There is no mark-to-market on risotto. It was only bought in the current year. They seem to have just left it at cost. But there was a mark-to-market on spaghetti and a mark-to-market on gelato, so I've just removed them. It would almost have been easier just to put mushroom in, isn't it? So whichever way you wanted to do it. If you wanted to ignore those two and just put mushroom in, that would have been fine as well. And then what you see is that this 4718 is to do with tiramisu. So that one doesn't have to do with any of these. So that one stays in. So that one stays in completely. This 6101, the to come off, we just left with the 500 Rand for mushroom. So after capital gains tax, 5124, 5125, I think. When I did on my calculator, I landed with a 5, but then on my, you got a 4. Okay, but in Excel, I landed with a 4. Okay, so that's my number. That's the profit number. Then we have to do the calc to give NCI their share of the profit. So here's my calc down here for NCI's share of the profit. I start with spaghetti. Spaghetti has a profit of 710. I'm going to adjust spaghetti by the numbers that I've adjusted at the top, because if the number's not at the top, I can't give NCI a piece. So I'm giving them a piece of what's not there. So at the top there, I started with 710 for spaghetti, but then remember I added the bargain. I took off the dividend received. I took off the profit adjustment, and I added back the depreciation adjustment, isn't it? Those are all adjustments I've made in that top number. That's the number I'm sharing, so I have to adjust it. So I adjust all of those out. I'm left with that. I give them 5%. You happy with that? Then risotto, I was given that number. No, it wasn't. It was 7 months of the number I was given. The NCI is 25%, and then there's the extra 5, which is 5 of the other 75, isn't it? So effective 5% of 75 and 20 and 25%. So those are the other 2 bits of NCI. So the NCI that I've got at the top there is that one, and that one, and that one. Yeah. Then I've got the other comprehensive income, which is of spaghetti. They're the only ones that have. 4718. NCI gets 5%. I get the rest. So then I just added that to that number. Remember, you've got to show the 2 pieces. You've got to show parent and NCI share of profit. Then you've got to show parent and NCI share of total. Okay, that's the 2 numbers you show. Happy so far with those? Okay. Then on this side, but that was with the bulk of them. How many marks was that? 20? 26. Yeah. There wasn't too much. It's just making sure because there's so many companies, you keep having to And I know I think you just have to just keep calm, because it's so much, and you're thinking, oh my goodness, I mustn't forget that, but you do have time for 26 and a half. 26.5 times 1.8. You have 50 minutes almost just to do the P&L, isn't it? It's more than enough time. Just take it slowly. Make sure that you dealt with. What I did is, as I went through each paragraph, I asked myself, okay, I first try to focus on the trial balance, and I try to say, okay, let me focus on here, put everything in that relates to trial balance. Then acquisition, put everything in that relates to acquisition, wherever it went, isn't it? And I just kept, it's almost like a puzzle. You keep putting pieces, and eventually then you can see where the rest need to go. Okay, on that side, statement of changes in equity, we start with opening balances. So share capital column is easy. Opening retained earnings, I kept messing up that number, but it's basically my retained earnings, my share of the since retained earnings of the subsidiary, and my share of the since retained earnings of the joint venture. The other subsidiary was acquired during the year, so they don't come in. So my share, my retained earnings at beginning, 310, I'm pasta. Then for spaghetti, they had 230 at beginning. They had 90 on NAC, so the movement is 140. So I would get a share of that 140. However, there were two adjustments, on-NAC adjustments. I never forget those on-NAC adjustments. Inventory adjustments and a receivables adjustment, which would have rolled the very next year. They roll the other way, isn't it? So they were minuses on NAC. Here they roll and they become pluses. So that becomes a plus, that becomes a plus after tax. And I land with that number, 149,360. I don't know why I have a gap there. I think I left it for the extra NCI, but then I didn't have one of those in that one. Oh, I can't do that. Oh, no, I think what I did is I added it on that side. Let me see. Okay, it's a line that I've added there. Okay, let's leave it like that. So then I get 149,360, and say I get 5%, I get the rest. So what I did with these two numbers is that the 141 I added to retained earnings, and then the 7468 I've added to NCI. I should have added to NCI at beginning, but I didn't. Did I? Yeah, what is this NCI?
The 42 is the
ONAC. And that's also ONAC? No. What is that? Oh, you know what that was? That was when I had the 710. Remember?
Yeah.
I had the wrong number, so I haven't adjusted. Is it just this one that I haven't adjusted? Or is it? I think I adjusted. I think it's just this one. Let me just see. What's the 575? It's the mark to market. Is the mark to market still right? Yeah. No, that's not 141. That's 7.468. Okay, sorry, when we fixed those numbers, I didn't fix. You can see it's similar because mine was also 468, but it was 33,468, not 7, because we changed just a big thousands number. All right, so sorry about that. So the 7468 goes to NCI at beginning, the 141 goes to retained earnings at beginning. Then risotto, there was no beginning. Gelato, beginning 215 on NAC 80, increase 185. There's no NCI here, there's just mine. My share of that 54. I add the 54 to retained earnings 310 plus my share of spaghetti plus my share of gelato 505. Mark to market at beginning is parent, and then I reverse the spaghetti and the gelato, which is the first journal entry that I always do to reverse any fair value adjustments made on subsidiaries, joint ventures, associates, etc., to get them back to cost. No problem. And then I added the subsidiary. Yeah? Do you agree with those? 12, 110? You were happy with that? Which one? The mark to market of the sub. Why? Okay. Do you see the sub has a mark to market, right? Uh, and 23755. Oh, okay, I've got a calc. Did you have 23755?
No, I didn't
Put it in at all. Oh, okay. So we do it just like we do a retained earnings, eh? So we do 23755 mark to market at beginning. We reverse the on-AC mark to market, which had been given, and then we have a movement. That movement, 5% goes to NCI, the other 75 goes to parent. So the 10933 is the parent's piece. It gets added, and then the 575 I've added to the NCI. So if we look at my calc, I mean, if you did the retained earnings calc, then this piece is so much easier to do. But it's exactly the same, right? When I do it with my bounces, it's the movement in retained in the mark to market from AC to beginning, isn't it? And I give NCI their share. So that's the movement, 11. I give NCI their share. I'm left with 10. So there's my 10, and there's their 575 going to them. All right, so mark to market at beginning is parent plus the share of the since mark to market movement in spaghetti, which had to do with a company called Tiramisu, an investment called Tiramisu. So it wasn't one that we reverse, because we only reverse if it's a subsidiary or an associate or a joint venture or a joint op. Okay. That gives me the 12110, and then the NCI. The NCI is the NCI on acquisition of spaghetti, the on-AC one, plus their share of the since retained earnings and the since mark to market, which I just went through with you. Then in the current year, I just put the acquisition in first. There's an acquisition of a subsidiary. We did that last week, 163,958. Then we have profit. That comes off my P&L numbers, 1727 and 93. Then the share of the OCI. They get 4482, they get 236. Are those numbers?
It doesn't add up to 500.
What?
I got 4888.
It's supposed to add up to this number. Oh, no, it isn't. No, because it must add up to that. Yeah, you know what? I put the wrong number in here. It's got to be this. Yeah, hang on. This has got to be 5.124 minus 0.236. Sorry, I forgot the parents piece. Is it 4888?
Yeah.
Okay. Yeah. I needed to have put the parents piece in there. Otherwise, if you take these numbers, it's the difference between these two. And then there was a dividend paid of 50. And here there's two pieces of dividend. There's 5% of spaghetti's dividend and 25% of risotto's dividend. How many marks was this? 18 or something? 17. So all in all, a big question, I think, isn't it? 40, more than 40 marks, 43 for the whole thing, but for this piece. Yeah, so, yeah, a big question. But when you look at it, just more fiddly than anything else, isn't it? Nothing that if I'd given it to you in a chunk, you would have said, oh, this is hard. Nothing, hey. I mean, such a small intercompany, just your normal dividends, even your vertical one didn't have anything like too major going with it, isn't it? Yeah, it was okay. All right. So I'm not going to bother to do D. D just asks you for 3 marks to explain how we account for joint operations. Joint operations are, you know that we account for our share only. Eh? We consolidate, but we only consolidate our share and we don't recognize an NCI. That's what a joint operation would have been. But we did do joint op journals. Didn't we have joint op journals? Oh, it was in the other paper. Okay. I start to get so confused with these papers. All right, let's see where we are. So we're here, right? Question 2 for 56 marks. I just want to make sure we can do it.
It's an associate to a sub.
We can't do it. I actually think that, yeah. I actually I had copied all the past papers onto my smart board, onto my smart tool. And then this morning when I was looking at it, I saw that I didn't have question 2 of this paper. And I thought, why don't I have question 2 of that paper? Surely, why would I, what happened to it? It disappeared. But that's why I don't have question 2 of that paper, because we can't do it.
Yeah.
Is it?
Yeah. They started the exercise significant influence and then they bought it and became
And became a sub. Okay, well then that one we cannot do. Called acquired shares. Yeah, we exercise significant influence. And then we acquired an additional and we acquired control. Okay. So, so this question we can't do because it's going from an associate to a sub and associates to subs. Is something that you're going to have to do at honors level. It would have been something that we would have done at third year level, but it's not applicable. It's been removed from the syllabus. Remember that I think you were out having your wisdom teeth pulled out. When we're looking at changes in ownership, we're only going to look at changes in ownership where there's no change in control. Yeah, so we're going to look at where it's a sub and it stays a sub. So it either becomes a bigger subsidiary or a smaller subsidiary. So we're going to go from 60 to 80 or from 80 to 60. Those are the only ones that we're going to look at, which is the one that we saw in the October paper. None of the other changes in ownership apply. So we don't have to do where associates become subs. We don't have to do where subs become associates. We don't even have to do disposals of subsidiaries when subsidiaries become nothing. And we also don't have to do cash flows. So, yeah, so this one we can't do, yeah, as you said. The next paper, but I think we must practice a change, isn't it? A change in ownership, 11. So if we keep moving back, we move to October 14. But have they left this May 14 paper in your, you don't know, in the pack that they send? We haven't even looked. No, I don't think so. They removed them, isn't it? That pack is much thinner than the pack.
Yeah, there's only like 10 questions.
Yes, because they removed all the ones that had cash flows or... Okay, so let's look at October 14. Let's just look at what this question is. This is Panem Everdeen Malloc. They acquired control of Everdeen. There was a disposal. They acquired 40% a joint op. They purchased all, huh? And then they disposed of shares. Not even all of them. A few. Okay, let's look at the percentages, because maybe this is one of those little disposals. Everdeen, 350 shares they have. We acquired 85%. Okay, so it's a sub that becomes a smaller sub. So this one we can do. All right. Oh, for goodness sake. Another P&L statement. They have a preference for P&Ls in this paper, am I right or not? More P&Ls than balance sheets show up here. P&Ls and journals. Huh? Okay. Let's quickly go through the numbers. So for revenue, parent, sub, joint op. Yeah. Parent, all of sub, all of joint op. Remember, don't make that mistake with like saying, oh no, it was this much of a sub for this part. It was a sub, right? The split for subs goes into NCI. Okay, so it was a sub for the whole year. So parent, sub for the whole year, joint op. Then we take out the intercompany sales. Cost of sales, parent, sub, joint op. We take out the intercompany sales. That's what I would have done first. Then, beginning of year inventory adjustment, end of year inventory adjustment. Yeah? Cool. Other income. Parent, sub, joint op. Then we remove all the dividends. There's two of them. There's the one from the joint op, and then there's the one from the sub, and there's a three. There's a pref div as well. We got half of the pref div. So we get 40% of the joint op, 70% of the sub, because that's all we've got left at year end, and 50% of the pref div. Is that right? And then what else are we removing from? We're removing the management fee, and we're removing the profit on the land. Yeah. Remember, any transactions with the joint op, we remove only our share. So we're removing the profit on the land, and we're removing the management fee. Yeah, that's it. Then other expenses: parent, sub, joint op, management fee again, and the impairment of goodwill. I didn't forget this time. The tax expense: parent, sub, joint op, and then the two inventory pieces: the piece for the land, the CGT, and what was that? 38. Oh, and that's the other inventory piece. Inventory piece, and CGT is the three adjustments there. And then NCI share of profit, you must just remember that up to the date of sale, it's 15%. After the date of sale, it's 30%. And then, yes, when we have inventory adjustments, the beginning of year inventory, because it's 4 months, we assume it was sold in that 4 months. And in the closing inventory, we assume it was sold to them closer to the end of the year, so we adjust it closer to the end. Yeah? And if you didn't put it in the right period, then the number would be slightly out because of the extra 15%. Yeah, so it was just a lot of calcs, I think, to do. Statements of changes in equity. Share capital is straightforward. Retained earnings was actually not too bad. Huh? The only adjustment to retained earnings, there was only one. And often there's like millions. The only adjustment to retained earnings was for that inventory at beginning, isn't it? So your retained earnings number is parent, and then movement or increase in sub, which I think was like 660, and then adjusted by that inventory, and we took 85% of that. So beginning of year retained earnings was okay. Current year came from P&L. Dividend came from TB. Yeah. This change in ownership, 3114, was easy to work out. Yeah. You had to just work out the net asset value at that date. The profit was split evenly, they said, 4 months, 8 months. And the only thing there again was to remember that you would have adjusted the inventory so it's in and out and it disappears. So you could have left it out completely, which is what I did. I just put in the movement in the profit and the 4 months, and then you work out and you get a profit. You get a net asset value that you disposed of 251-ish. You sold it for 255. You made that much profit. But now, profit on the sale of an investment in the company's books, in the subsidiary, in the group, goes to statement of changes in equity, isn't it? I actually didn't show you the other one. Must have skipped it when I was going through those numbers. I went one too far. It's here. The 129 is over here, 129,706, right? Which is just sold over old, what I sold over what I had bought, times the 710, gave me a cost of 120 something, 125, 294. Sold over old, times the 710 gives you 125. We sold for 255. So in the other income of the parent, in that 386, is this number, which is profit on sale of 15% of my shares. That is where it lands, isn't it? When you it isn't always where it lands, because if you carry an investment through OCI, it lands in OCI actually, isn't it? But for your purposes, they usually say it's cost, just to make it easier. When you get to honors, then you need to read very carefully how it's treated. Then, so that's where it is for the company. That's why I'm minusing it, because I'm reversing it, because I'm now doing group financials. And for the group, it doesn't land up there. In the group, it lands up here. NCI at beginning is ONAC plus my share of the since profit. So that was ONAC. Was that the ONAC? Yeah. And then that's my share of the since profit, the 96. And then remember that when we have prefs, we have two NCIs, isn't it? We have the NCI for the odds and the NCI for the prefs. So the NCI for the prefs is the other half The other is at 50%, is 50% of the 40. You remember in second year we dealt with all those arrear pref divs, eh? You won't see that at third year level so much because we don't deal with pref divs again at third year level. So when they give it to you, they kind of give it to you quite simple like this one. But then when you get to honours, you do see it again, isn't it, with the arrears. Although this time you did need to be a bit careful because when you did the profit split, you first had to split between odds and prefs, and then what was remaining was that needed to be split 4 months, 8 months, isn't it? So you first had to take the 6.4 of dividend out because they did say to you that there was a dividend paid, so that bit must come out first. Otherwise, everything on here, yeah, remember they get a pref div too, isn't it? So that NCI, there's actually 2 of them, and we mustn't forget when we have pref divs, there's actually 2. There's a 30% NCI and there's a 50% NCI. This one is for the pref, that one's for the ord. Okay. Let's see where we are. 11:30. We due to finish? Oh, at 12, in half an hour. Okay. I think I'm just going to spend a bit of time just running through, and then if you've got any questions, you can ask me. All right, so in second year, we had looked only at subsidiaries, isn't it? We had looked only at subsidiaries, but what we've looked at in this module is we've looked at various ownership levels. So if here's the parent, we looked at the instance where, and we do come across these in questions, where we have between 0 and 20%, and it's just an investment. And these investments that are just investments are carried at fair value, and we account for dividends in our P&L. Do you agree? Then we looked at an investment which is between 20 and 50%, and we looked at a couple here, but the main one that we looked at was an associate. You could also have a JV, isn't it? Because they're accounted for in the same way. And the way associates and JVs are accounted for is that we account for them in one line. One line, isn't it? So we account for the percentage NAV that we have plus goodwill as one line in the statement of financial position. We call that line investment in associate. Right? That is the number. If you went and checked, if you went and took the percentage NAV of the company plus the goodwill, any adjustments that you would need to make to get it to fair values, right, adjusted NAV, you would land up with the number that we put in investment in associate. When we do this investment in associate, we actually don't work it out in that way, isn't it? The way that we work it out is we say cost plus bargain. If I add the bargain, I land up with real NAV, isn't it? If I take cost plus bargain, what I land up with is NAV including goodwill, because my cost would have been in my goodwill number. Do you agree? That's on acquisition. Then I add share of retained earnings since acquisition. And I say retained earnings, but you know that I actually mean all reserves, isn't it? And I add share of profit in the current year. So this is what the net asset value was on AC. From on AC to beginning of year, equity increased. This is what equity increased by. So it must mean net asset value increased, isn't it? In the current year, equity increased again, profit. So that must mean net asset value increased. Do you agree that it keeps representing my share of net asset value? And then, if they've paid a dividend, I take the dividend paid out, because then their net asset value must have dropped because they paid out cash. Cash is an asset. And then I land up with equity accounting at year end. Yeah. When we look at what we had before to what we have now, yeah, then the adjustments that we need to make, which we must always make, for almost every investment we have is that we must reverse fair value adjustments. Yeah, when I'm going from there to here, because I want to get back to cost, isn't it? And I must reverse this dividend, because I'm not going to account for the dividend received, I'm going to account for share of profit. But here's the reversal of the dividend, isn't it? The dividend, which before was in other income, is now going to go to balance sheet. Okay? So that's investment in associates. It's one line. This is the hard one to work out, isn't it? When on the other side in the P&L, we have actually got two lines. We've got share of profit of associate, and we've got share of OCI of associate. Yeah, and that's pretty easy to work out. It's just your percentage share. Okay. When we're dealing with joint ventures associates, we need to be careful because of intercompany transactions. Yeah, and we're always a little bit careful with intercompany transactions anyway, because we always have to look if it's up or downstream because of NCI. But here we have to be even more careful with up and downstream because of where the adjustment goes. Yeah. So if I have a parent that sells to an associate, I have a downstream. The associate has the asset. The parent has the profit. So when I adjust, I must adjust share of profit in associate. Investment in associate. Investment in associate adjusted. So that makes sense, right? Because they're sitting with an asset inventory, which was sold by the parent. Yes, from a group perspective, the value of that asset is overstated, isn't it? So that adjustment would have landed up in my calc here, isn't it? This adjustment lands up here as an adjustment. Yeah. So over here somewhere I would have intercompany adjustments as well. Let me see if I can maybe move some of these. Oh, maybe with my, if I pick it up here rather. Intercompany adjustments. Remember that there's a temptation, and I always also had it, to do the intercompany adjustment between investment in associate and share of profit in associate. But it's not true. Yeah? When we make adjustments to share of profit in associate, it doesn't go to investment in associate. When we make adjustments to investment associate, it doesn't go to share of profit in associate. What that means is that this number there is not always the same as this number here. Okay? Because when I have a downstream, I adjust investment in associate. The other side I adjust is cost of sales in the parent. Do you agree? When I have an upstream, the parent has the asset, I adjust inventory. The associate has the profit. I adjust share of profit in associate. When I adjust this share of profit in associate, it adjusts that number. It does not adjust that number. Do you agree? Because the journal entry is not between there and here. The journal entry is between there and inventory. The journal entry that happens between there and here is just for the straight percentage of profit. Like we had in that question that we had earlier, it was just a straight percentage of the 24. So the straight percentage of the 24 goes there and comes here. Further adjustments, some of them go here, some of them go there. And we could land up with that number not being the same as this number because of those adjustments. You understand that, isn't it? Okay. So that is associates in a nutshell. Intercompanies with associates, you know, it's the same pretty much as parent. It's 40% only. Sorry, as groups, as subsidiaries. It's 40% or your whatever percent only. And it is, you need to be careful with direction because of the accounts that you can adjust, isn't it? So if they have the assets, we can only adjust investment in associates. We can't adjust inventory or PPE or ACDEP. You can't adjust those, isn't it? Down here, if they have the profit, we can't adjust other income, cost of sales, depreciation. We can only adjust share of profit in associate. Hey? So be careful with those. You know how I like to do them. Put the journals down as you normally would do for groups. Make it the percentage only, and then adjust the accounts for whether it's up or downstream. They will ask you either a joint venture or an associate because they're the same. So you might find one in an exam or the other. Then we looked at, we also looked at where we have, and it could be anywhere, usually it's below 50% or 50%, but we also looked at, if here's my parent, also looked at a situation, so we've got the 0 to 20. In the 20 to 50, we looked at also a joint op. Joint ops are the easiest to do. You hope that you'll get joint op journals, because those are very nice to do, isn't it? Journals. Let me just go back to associate journals. When we do, if they asked you to do associate journals, right? Here's my journals. Reverse that. Reverse the dividend, take it against the investment, isn't it? Put in the bargain. So the ONAC journal here is just the bargain. Yeah, so journal 1, reverse. Then you do the ONAC, you just put in the bargain. Then the since is just bringing in my share. The current year is bringing in my share, any intercompanies, and reversing the dividend. Those are your journals, if they did ask you. But they usually say to you for associates, do this journal and that journal and that journal, isn't it? They don't just say do all of, well, you never know. But for joint ops, they sometimes say just do all the journals. We practiced one in October, hey. They're very nice to do. How do we account for joint op? We bring in our percentage of assets, liabilities, income, and expenses. We eliminate equity. Equity on EC. And so then we land up, also the only extra thing we land up with here then is reserves. I'm just going to say retained earning, but you know when I say retained earnings, I mean all the reserves since AC. And it's also then just my share. You know, I'll end up with my share, assets, liabilities, income and expense, and since AC reserves. That's what I'll end up with in my accounts. No NCI, no one-liners, no funny things. When we do intercompanies here, we just need to always be careful with joint ops that I'm always only dealing with my share. Okay. And then we looked at subs. 50 to 100 is our subs. Now with subs, what did we do that was different this year? Not much, hey. We looked at a couple of things that are new that we hadn't done. We looked at where NCI is at fair value. We hadn't done that in second year, but it's not a train smash. They have to give you the fair value, isn't it? It just means they have a piece of the goodwill. It becomes more important to determine how much their goodwill is when we are doing disposals, but we skipped that. So from your perspective, this is like a non-event. Do you agree? It just affects the number that I use in the beginning to calculate the goodwill. And you know there's that calc which I always do, which is fair value assets and liabilities plus any adjustments gives me my fair value, and I take out my NCI, it gives me what I acquired. I remove what I paid, and then I'll end up with goodwill. The other thing that we looked at that was new is that we sometimes landed with a bargain. We also hadn't looked at bargains in second year, but this time we have. We know that bargains land up in two places. They either land up in P&L or they land up in retained earnings. It depends when that bargain happened. We also looked at, and I don't know if we had looked at it, I think we had. The other implication of this NCI at fair value has to do with goodwill impairment. they get a share of goodwill impairment if they carry that fair value. If they're not, they don't, isn't it? Because if they carry that fair value, the goodwill represents 100% of the goodwill. If they're not, then the goodwill only represents my share of the goodwill. Okay, so be careful with that. They get a share of goodwill impairment if they carry that fair value. What else was different? The adjustments. Oh, I know what else was different. Tax. Tax coming into our adjustments. We didn't have it before. Tax also came into our intercompanies. We also hadn't done that before. Yeah, but it's fairly straightforward, isn't it? Remember the rule for the tax? In the same place, the other way. So if I'm debiting cost of sales, I'm going to credit tax expense. If I'm debiting inventory, I'm going to credit tax. Yeah, I'm crediting deferred tax. So it's always in the same place, the opposite way. What else did we do with subs? Nothing else really there, because then the only other thing that we did was we looked at change in percentage. But it stayed a sub. Yeah? And what we said is when there's a change in percentage and it stays a sub, it goes to statement of changes in equity. It is not goodwill and it is not profit. Yeah? So if I buy an extra percentage and I pay more, I don't think it's goodwill. Why? I already had control. You pay goodwill when you acquire control, isn't it? This is just seen to be a transaction between owners. It sits in statement of changes in ownership. If I sell, like happened in this question, and I make a profit, I don't account for it as profit. I just account for it as a transaction between owners, and it goes in statements of changes in equity. In third year, in honours, you're going to look at something which is share buybacks, when we buy back shares from shareholders. And you've seen it maybe a little bit with earnings per share, when we do issues of shares to shareholders at below fair value or above fair value. Any transactions with shareholders in that way do not affect P&L. We don't consider it to be profit that we're making because we are entering into transactions with shareholders, isn't it? Transactions with shareholders just go in at value, whatever it was. If I sell shares that are worth 10 Rand for 2 Rand, they go in at 2 Rand. I don't put them in at 10 and show a loss of 8. If I issue shares that have a value of 10 Rand for 20 Rand, I don't recognize a profit of 20. So that's a bit like that, isn't it? I had shares that were worth more, but I got less. Or they were worth less and I got more. So what? I stick it in statements of changes in equity and it just sits there. There is a thing that then later you would be allowed, or that you would be allowed to take it out of that change in ownership eventually when that disappears, but that's, something for later times. Yeah, that's it. I don't know, did we see ever a thing where there was a reval or a mark to market or something like that with a change in ownership? No, okay. Because do you agree that if there was, say, a reval reserve and there was a change in ownership, some of that value change is because of that reval reserve, the increase or decrease in that reval reserve. So now if the percentage changes, the amount that should be mine and the amount that should be the NCI's also changes. So that reval reserve should move as well, isn't it? But we do a transfer to fix it. But I don't think it's something that we see at this level. Then we skipped the rest, right? We skipped any other changes in ownership, so we never saw any movements that were like, we would have normally seen a sale like from here to 0 or from there to 10%. We also would have seen sales or purchases between associates and subs like that. We also would have seen where the parent issues more shares and it lands up shifting your percentage that you own. We didn't do any of those because they limited the syllabus. And then we also didn't see cash flows. Yeah. But I don't know, I think I'm comfortable. I mean, that girl that sometimes comes, sometimes doesn't come, she didn't seem so comfortable the other day, but then she seems to have missed a lot, isn't it? You were lucky because that time that you missed, you just landed up missing that one change, and then we didn't actually do any more after that. So you were okay with the change today? I think was there a change in October as well, but it went the other way? No change. Okay, so October has one where it goes up, May has one where it came down. So you've got the 2 examples, that's all they can ask. So exam is soon, huh? In 2 weeks? But it looks like you're fine. You've got all the past exam papers that you need, you've got all the solutions. If there's something, you've got my number. You can just give me a shout.